Today is Wednesday, the 27th of February, 2008, and this is Brian Shannon from Alpha Trends. The market's closed. I've got the S&P 500 showing a loss here of 34 cents, trading at 138.03. And the market finished, with a green candle, but that just all that means is the close was above the open. It doesn't necessarily reflect whether it was a net positive or negative for the day. So when we look at this daily time frame, the first thing you should immediately notice is that the market seems to be doing battle with this declining 50-day moving average. And I emphasize the word declining 50-day moving average, or the one word is declining that I emphasize, because it's really more the direction of the moving average that matters than where the market is in relation to it. In other words, a lot of times you'll see that the market can get above a declining 50-day moving average for a couple days, and that gets a lot of people excited and thinking that the market has turned around. But as long as this moving average is still declining, it says the average trend, the average price over the last 50 days is still declining. Now, that means that it's going to be very tough for this market to really sustain a rally going forward. When we look at the daily time frame, we've got this high right here at about, again, 139.70. And we said that a couple days ago that breaking above the 137.20 would likely lead to a test of that area. It seems as though it's making a run for that level, and we've just got all these different little areas of potential support and resistance now, this being the resistance level, and now we would expect that that 137 level does hold as support, and on any pullback for at least the short term. But with this bigger bearish picture looming, you just can't have much confidence in the upside still. And also we've got that 200-day moving average declining. And again, I point to the much longer term that it doesn't, that 200-day moving average doesn't get declining very often. So when it does, it takes a while for it to turn back around. So a lot of reasons to really still be very careful in this market. If you were just looking at this 30-minute time frame, you'd say, well, it's above the advancing 5-day moving average, and that's generally bullish, which it is. However, with this bigger level of potential supply looming at 139.70, and then above that we've got the 141 level, and up here at 144. There's going to be it's going to be very difficult for this market to really make any headway. A few days ago we were focused on this pattern. It looked like maybe it was breaking, and from that failed move, that failed breakdown, came this fast move higher, and this market is just capturing a lot of people off guard, almost on every other day. It seems as though maybe a trend is going to hold, and that was below that 134 level, and then it comes back and breaks out to the upside. And now if this fails, we're going to trap the longs in here. So there's a lot of frustration out there from traders who are, really, I think, focused on trends more than just a couple days, and that's why I continue to believe that the best way to handle this market is from a day trading perspective. And if that's not something you're comfortable with, then the other alternative is always cash. Cash is a position. It allows you to remain objective about the market while you're kind of waiting for clarity and avoid the risk. You use multiple time frames to leverage you use multiple time frames for leverage, basically. Leverage of knowing when to be out of the market and when to be in at the right time to take advantage when the market is moving in your advantage. If we take a look still at the actions of the Federal Reserve since the 75 basis point rate cut right here, the market is still holding bullishly above that level, which gives the benefit of the doubt to the buyers here since about January 18th, when that first aggressive cut campaign began. So that's one bullish scenario in here. But right now, realistically, we're just in this bigger, wider range of 132 to 139.5, 140. So just continue to go slow until we get better indication of what this market really wants to do. Cash, again, gives you the objectivity to stand on the sidelines and wait for things to become clearer. The S&P, the semiconductors rather, we were looking for a move past 28.5, in this market. I thought 20, maybe it was 29.5. I'm sorry, I don't have my notes in front of me. I was going off memory, but 29.5. I thought maybe we get a test of this next level, which again is only at about $30.30. So there's not really much reason to get excited in here. It closed above the 50-day moving average, and a lot of times, you get maybe 1 or 2 days close above that 50-day moving average. People get excited, but the rallies generally fail until this 50-day moving average has at least flattened out, and then we have the 10-day above the 20-day moving average and the 20-day above the 50-day moving average. So still a lot of work needs to be done before we can really start looking for any kind of sustainable bottom in any of these markets. The Russell 2000 is also doing battle with its declining 50-day moving average here, and you can see it's tested it here the last couple of days and closed below it on both occasions. It lost 7 cents today, so really not much damage done, but really, again, the key level in this market is going to continue to remain at that $73 level. A lot of times, again, you might see the market close above that 50-day moving average and maybe even come up above that 73-day moving average. It's not necessarily the breaking of a trend line or the breaking of a moving average that we want to be aware of. For instance, when we saw that this trend line was broken, that was good. It was a good start towards a breakdown. But more importantly than the breaking of a moving average or breaking of a trend line is the subsequent action. Is it able to hold on and create and establish a pattern of lower highs and lower lows right here? It was not, so more people get trapped. It leads to these bigger moves higher. It broke the downtrend in here from that symmetrical triangle we were tracking, and now it's kind of still just toying with that level. And more importantly, again, is going to be the 73 level. That is the kind of the line in the sand for the IWM as far as where the buyers have the potential to gain control. If it gets above there for a session or two, we still want to be very, very careful because, again, the declining 50-day moving average indicates that there's still net sellers in this market. And bear markets will trick you into getting long before they decline. That happens a lot. And when you look at these weekly time frames, there's still a huge mess. There's still a lot of reason to be concerned and a lot of reason to think that this is just going to take a lot more time. And I still think we have the potential for a test of these lows at some point. I don't have a crystal ball that indicates when that's going to come or that tells me if it will in fact come. But with the primary trend still lower, with the declining, and I define that by a declining 50 and a declining 50-day moving average, with the 50-day moving average under the 200-day moving average, the market still remains guilty till proven innocent from a longer-term time frame. From a shorter-term time frame, here we've got a little bit of support in here, maybe about $70.75 the last couple of days. Below that, we've got a advancing rather five-day moving average, and in here on this 30-minute time frame, we've just got a real choppy, messy pattern in here. The most important level of support right now for this market is around $68 a share, breaking below $68 a share. So it's basically this market, you got to look at it as range bound from, we just take horizontal lines here, from 73 down towards $68 a share. That's really what this market is doing. And when this, and then the range is just getting tighter and wearing more people out. And again, that's why you want to either stay on the sidelines if you're not comfortable with this environment and not get your account churned up in the commissions, but wait for trending opportunities. And there are still some good trending opportunities out there. A couple people did want me to mention the Capstone Turbine. This stock had a great breakout a couple days ago. You saw that was making these higher lows as it came up towards the resistance at about 165. It rallied on big volume here 2 days ago, consolidated on light volume, made that little triangle that I had drawn in there, and continued higher once again today. And Capstone, if you look at the weekly time frame, is really starting to look like those short sellers are in a lot of trouble. I wouldn't chase the stock here. I'd wait maybe for a pullback down towards 175, 170 or so over the next few days. Another good-looking stock right now that's starting to set up a little bit better is this Brigham Exploration. BEXP is the symbol here. Looking at a daily time frame, getting above that trend line that's held it here a few days, or I'm sorry, for a few months. Could maybe turn this one back higher again. It's I'm looking at maybe buying it above that level. The buyers are similar to the capstone, getting more aggressive in here, but. If you decide to trade these things, risk management is job number one. We're in an overall declining environment. I think your worst case stop goes below $7.20 on a stock like that. Let's take a look now at the NASDAQ 100. I posted a chart earlier in the day to my blog about the pattern that was setting up in here and the potential for some maybe a short squeeze, a little bit of a short squeeze push higher if this market was to get above 44.50. That's the level we were looking at a couple days ago. And now we've got these higher lows in here. We've got an advancing 5-day moving average. I really don't like to make too much of these patterns because, again, like I said 2 days ago, people really, based on the emails, people really look at them way too literally. A lot of patterns fail. So it just provides a way of looking at the market and giving us a little bit of clarity and potential scenario is all it is. If it breaks above there, it doesn't mean it will run up to the height of the pattern added to the breakout point, which indicate near 46. But then again, if you look at 46, it looks like a reasonable target too, because that's the prior level of resistance here, and that's where that 50-day moving average may come down and meet this market. So again, the theme remains. There's a lot of mixed messages in this market right now. And I don't think you want to be too aggressive, either long or short. We're in a bearish environment, and defense wins the game.